seller financing. And as the name suggests, it's literally whoever's selling the business will effectively become the bank and loan you the money for the business by you, through a multitude of different ways, basically paying them back over time. So it means maybe you only need 50% of a loan from something like the bank or the SBA, and then the owner carries the rest of that sale price as their own personal sort of banking system, if you like, and they lend that back to you. Why would they do that? What's the advantage to them? Well, the big thing is, for an owner, if they offer seller financing, it really helps them from a tax point of view. If you've got a $3 million business and you want to sell it, and you end up with $3 million check landing in your bank account, that's a lot of money that you're going to pay in tax. If you can spread that out over, say, maybe 5 years, it's the same amount of money, but the tax advantages are different. Now, clearly, I'm not an accountant. I don't know the full ins and outs. Everybody's circumstances are different, but generally, for the vast majority of cases, there's big tax advantages by a seller often offering seller financing, and that can help you and help them. And also, what it allows for a seller to do, not all sellers want to sell a business, walk away, and then just high five you as you take over and then never to be seen again. A lot of sellers have built this business over maybe 20, 30, 40 years. They don't want to just walk away from it. They don't want to just leave all their employees high and dry. They might actually struggle to walk away from the business, and they want to keep some ties to it, and over time move away from the business. So for them to offer seller financing is a really good way for them to do that. They might also do it because they want to keep a wage. They might have a reason as to why they want to do that, but maybe they're a motivated seller. Let's say they've maybe had a heart attack, as a good example. They want to walk away from the business because they have to, because of their health. They want to spend time with the grandchildren, with the children. They maybe want to do some charity work, spend more time in the golf course, but they don't want to completely walk away from the business. They want to keep an income coming in because they've still got a mortgage to pay, still got a gas bill, they've still maybe got the kids in college, something like that. So for them to offer financing where they basically, let's say they were offering $1 million seller financing, they might offer that at 10% a year, which means that they will get a check every single year from you, or every month, that covers that 10% interest payment plus paying down the actual loan that they've given you. So if it's $1 million, let's say over 5 years, that'd be $200,000 a year plus the 10% on top, which would be another 100,000 in total. Obviously, it's spread out. So it allows them to have basically mailbox money. They're not doing anything for that money. It just arrives in the bank account or in the mailbox every month when they get that check. And it allows them to get on with their life and do what they want to do, but actually have that money, but without any of the stress. It means that they're not walking away from a business that they've built up over all these years. And that, for a buyer, is a really good situation. It means for the seller that they can easily sell a business, because for buyers, it means they don't have to deal with a bank. And for the buyer, it means that you've not got all the stress of maybe like 3-4 months for the SBA to catch up, to go through all the financing, for a bank to say that we're going to do this interest rate, we've got these restrictions, we need this, that, the next thing. If you can get a seller that would do 100% owner financing, that is between you and the seller, and you can come up with whatever terms you want to buy that business that works for you, that works for them, and you can negotiate to get that win-win, rather than the bank saying, this is it, this is the only way it's been done, this is how it's laid out, which doesn't leave a lot of leeway for you and the seller to actually do something. So that's why seller financing is a good thing. It works for both sides of the buying equation, both the seller and the buyer. But ultimately for the seller, it's a really good way for you to structure your deal how you want, and to keep an income and to lower your tax burden.